Hey everyone, I got an exciting show for you today. We're going to talk about what might be a hot thing to do in the upcoming kind of market turmoil, and we're going to do that with Greg Dickerson. How you doing, sir?
I'm doing great. How are you?
I'm doing well. I like talking about making money. Making money is a
Yeah,
good
man.
topic.
Yeah, hot market, and in a heat wave.
Yeah, so I think there's a lot of stuff going on. I think the last couple of weeks we've talked about exodus from big cities to the suburbs. We've talked about high tax states, low tax states. And one of the things that I'm stumbling across right now from this channel is there are a lot of people um, that are going to make a lot of money flipping single family homes. And I thought you and I could talk about that today because I think you have a couple of examples.
Yeah, exactly. I have so I coach some people that are flipping houses, and I've got a couple of clients that I'm working with in two different areas, one in Florida, the other one in North Carolina,
Mhm.
and they are both. One of them went under contract, had 12 offers in one day, and they're going to make a $90,000 profit on I don't know, $300,000 flip. That's the biggest profit they've ever made on a single flip in their entire career.
Mm.
And the cool part is they would have never got the deal had I not coached them.
Oh,
So
yes.
it's just what you know, right? This is a deal that through my coaching, that's how it came about, and that's how they found the property. And of course, timing is everything, right? So inventory levels have contracted significantly with coronavirus. So there's a lot to that. It wasn't just because I'm coaching them; they're making that much. There's huge pent up demand
Yeah.
with interest rates and everything. So it's a perfect storm. My other client in North Carolina, um, he had a deal that he was falling apart, didn't know how to do it. His lending had fallen through. So he hired me, and I've been coaching him to help him resurrect that deal. So
Yeah.
not only did I help him resurrect it, I also showed him how to fund the rehab and everything and take the property down with almost no money out of his pocket. And he's going to make the biggest profit he's ever made on a flip. And it's his first one.
Huh.
And I've kind of coached him through the whole process too. I mean, he'll make probably 60, 70,000, if not 80 on that one.
Wow.
And same kind of thing. He's got multiple offers on that property too. So pretty interesting times out there.
Yeah, so let's kind of break this down, and I think we're seeing this again. We have to remember that there will be some winners and losers in the next 2 to 6 quarters. Losers are going to be the big vertical cities. Clearly, that's you know, renters are becoming owners, and their renters are leaving big cities and going to the suburbs. So let's first get all the negative Nancy's out of the way, and we're going to just talk about the suburbs that are winning. And I think flipping homes is going to be very profitable
So the
because
city's an interesting conversation because,
okay.
yeah, there are people leaving, moving to the suburbs, but it's not enough to really make a huge dent. But
Mm,
it is enough to create opportunity for people that would rather buy in the city now and lock in at these low rates instead of these high
mm,
rents. So the same kind of thing is happening in the city. There's not as much demand. There aren't multiple offers, things like that going on like there
right.
are in the suburbs because there's a lot more inventory. So what you're going to see in the cities over the next few years, and even San Francisco hasn't changed. San Francisco is still a multiple offer,
Mm,
high dollar, you know, prices are still escalating. There's certain areas and certain pockets of different areas
yeah.
where it's happening. But when you get into the big cities like a Seattle or like a San Francisco or like a New York, in some of those areas in certain
Mhm.
pockets, you're starting to see a glut of inventory. So
Yes.
it's creating real opportunities for people to step in and buy some, apartment buildings that they otherwise wouldn't have had access to. So,
Yeah.
it's a double-edged sword there.
Yeah. What I would tell you is big cities, the one Seattle, San Francisco, New York, whoever you want to call, there will eventually be tremendous opportunities, right? But I've seen this movie before. Listings start to rise, and we're in that rise now.
Mm-hmm.
Pain will grow because people don't want to hold vacant properties and have two mortgages and blah, blah, blah. So there will be some time over the next 4 to 10 quarters where there will be steals in the big cities. I don't think deals getting done today are steals, but there will be. Yeah.
Oh yeah,
Yeah. Today it's
in
about
all sectors,
in all
all
sectors.
levels, all sectors. Yeah.
Totally agree. It's out there. I got dry powder waiting for that to happen. So I agree with that. But today it is the suburbs because so I've done Vegas. I just did an interview with a broker from Phoenix yesterday because I'm seeing this over and over and over. Record low supplies. I mean, Phoenix going into this crisis, I'm going to go from memory. I think they had 12,000 active listings. It got as low as 10, like in April when nobody was doing anything. It shot back up to 12 or 13. Now they're at 8. Just the supply has gone away, right? The new listings have gone away. The builders are building as fast as they can. So if you can come in and use that as an opportunity, right? Buy a distressed asset, find a way to fund it with hard money or private money or whatever, because the winners now are ones that can develop product that passes FHA, right? That's
Right.
the hurdle, right? And FHA buyers, which AKA are owner occupants, they're coming in with 3.5% down. And now if they're qualified, getting rates under 3. So it's,
And, reports
crazy.
are out there that the rates are, they're predicted to fall even more. There's an article out today by Lending Tree, expecting rates to fall, even more. Housing starts, interestingly enough, were a little bit off in some markets, but, again, that was people shutting down because of coronavirus and, they can't get their permits through the pipeline with some of the municipalities. So that's going to create even more demand and even less inventory. So the last reports I was hearing from like Case Schiller and, home builders, resources were that, and I know it's true with the labor shortage out there and with the difficulty in the entitlement process, permit process, and supply chain, we can't build our way out of this inventory demand over the next 10 years. We could not build fast enough over the next 10 years to create enough housing to balance this demand out.
Yeah, the other thing that I think I'm going to watch is I believe housing is not like the stocks, right? Stocks move every minute, up, down, crazy. Developers, they're making investments that are going to be a 2-3 year project. And the reason I think that is important is I think there were some projects being started in areas that were great in January that are horrible in July. And flip, right? There's not enough building going on in cities and suburbs where there should be, and now demand is up even more. So when you look at that mismatch, this virus has changed consumers, and it will take a while for builders to adjust. So we may have we have less building, but we even have less building in the right spots, if that makes sense.
And here's the thing. So that makes a lot of sense. Now here's a couple of things that are going on. Number one, everything that we're experiencing July of 2020, July 20th, 2020.
That's right.
That's pretty interesting. July 2020. So we are on the rebound with coronavirus. We haven't entered the fall yet. So we don't know what's going to happen. We don't know what this is going to look like. We don't know what it's going to shut down or how long. All we know is it's rebounding with a vengeance in terms of, caseloads and hospitalizations are on the rise. As we get treatments and we get better with the treatments and the vaccines, which are expected end of this year, first of next year, we could get things under control. So once it's under control and it's behind us, where there's no longer any worry about getting it, there's either a vaccine or a treatment. So that's off the table. Then what does the world look like? Do people come back? Do they say, you know what, we don't need to worry about this? So this is a short-term temporary thing in terms of people's behavior right now. So that demand might dry up at some point when they're out there, they've ridden the storm out, and then they say, man, look how cheap apartments are in these cities and condos are in these cities. So boom, the surge could go back the other way. The other thing that's really interesting is, and of course, this is all interest rate driven. What's driving the demand in purchasing is interest rates. If the interest rates were not where they were, people would stay put because it wouldn't make any sense. So they're buying more house, more room for a lot less money because of interest rates, and it's cheaper to buy than rent right now when you look at interest rates. The other thing is home builders. So there's demand, and they're selling as fast as they can build, but they're not building in anticipation of selling. They're building to the sale. So they're not throwing thousands of spec houses out there like we saw 2008 and 9.
You're right.
That caused the crash, where literally people forget. You talk to Steve Trang out there in Phoenix. They had subdivisions with 1,400 to 5,000 homes that were built, completed, and vacant. Nobody bought them. That's how far ahead of the supply we were in 08 and 09. So all we've really done is work through some of that. Some of that stuff was demolished. They went in, the banks went in and just tore down entire subdivisions.
Wow.
So there were slabs everywhere. People were pitching tents on the slabs and living in them. There was tent cities. They're probably still out there, but some of these communities were bought up and they continue to rebuild. But builders are not getting ahead. So that's the interesting thing to watch, because they all know as well, it's interest rates. They got burned before. We all know it's all interest rates. And it's all about this trend right now that as soon as we get this behind us, people love the cities, man. They just love that. and it's going to come back,
Well, then let's talk about the flippers and making money, right? I
Mhm.
was seeing a 6 to 8 quarter, so call it a year and a half to 2 year window, where if you're buying the ugly duckling on the street and you're buying it right, there's always that
Mhm.
caveat. You can make some good money flipping to FHA buyers. But maybe what I'm hearing you say is that might be risky because maybe it's only a 6-month window. What do you think?
It's all interest rates, so that's the key. You got to watch those interest rates. So if interest rates start creeping up, it does two things. Number one, it reduces the amount that somebody can buy. So
Correct.
for every point, I think what it is for every point in the interest rate. So if it goes from 2% to 3%, it can reduce the price point of a house of what somebody can buy by $50,000 or more,
Yep. That's what I've heard.
depending on how low those rates are. So the higher you go, the more it inflates that discrepancy. So I'd have to do the math, but that's what you got to watch. And that's what happens with builders is builders, with the price point, they'll go out and they'll build inventory thinking, man, I can sell these houses for 500 grand. The interest rate ticks up a half a point to
Yeah.
a point. It's like, now I have to sell this for,
450.
450,
Yeah.
or 400. So that creates a problem. So as a flipper, you want to make sure that you're looking at a 90-day in and out.
Okay.
I'll tell you the sweet spot where there's really opportunity is to be the guy that finds the deals and then sell them to a flipper. And just make that spread,
The wholesaler.
Yeah. Wholesaling is where it's at. Realtors, get some investors on your list that are buying and flipping, but finding the properties that are ready to sell, that's where the gold is right now.
Well, let's talk about that a little bit more because I have my opinion on that. So let's see if I have it right in your opinion. Basically finding distressed sellers, right? Distressed assets. In my world, that's something that doesn't qualify FHA, right? Maybe it's a bad roof or there's something with it because anything that can go FHA is going to get bid up, period.
Mm-hmm.
There's just not enough supply in most cities. So if you can go in and find an asset like that has something cosmetically wrong, roof, windows, paint, whatever it is, or they're in a situation where they need cash fast, they're moving, they inherited it, whatever. Those are the opportunities to look for because you can lock them up, sell the contract to a flipper and move on. Is that fair?
Yeah, or you can do, if it's just cosmetic, you can just do it yourself, but you don't even have to close. So, you can make a good spread without even having to close and just,
Mm-hmm.
have no risk, nothing like that. So I guess what I'm saying is the key is in finding the deals.
Right.
So the key is not in renovating and selling the house. It's in finding the deal.
Yep.
If you can find the deal that has margin, then you have a lot of options. You can keep it and rent it. You can flip it, and just make a an assignment fee. People call that wholesaling,
Mm-hmm.
tying a property up, putting it under contract. And then Michael, I come to you, say, hey man, I got this house. They're willing to sell it for 100. It's worth, 200 after it's fixed up.
Right.
I'll assign you my contract for 20 grand. You'll do that deal all day long.
Yep.
So that's the assignment of a contract. People call that wholesaling.
Right.
Wholesaling really technically is buying and then buying at wholesale, then reselling at retail. That's what a wholesale transaction technically is. So
Mm-hmm.
what we're talking about is the assignment of a contract, which is legal in most states. Some states are requiring licensure to do that now, which again, if that ever got challenged in court, I don't think it would hold up because when you contract a property, you have equitable title. But anyways, the key is in finding these motivated sellers. So you call them distressed. And what you're really looking for is motivation. It doesn't necessarily have to be a distressed property in the physical sense of disrepair.
Okay.
It just needs to be a motivated seller that has to sell
Mm-hmm.
for any number of reasons. And that can be at any level. So FHA isn't necessarily the key. It's, conventional financing is the key. So they have to be able to get a conventional loan that's not jumbo. That's where your rates are really sweet right now.
Yeah.
FHA, a lot of times people equate that with first-time home buyers.
Okay.
So, as long as it's conforming, conventional, and below the jumbo threshold, there's really cheap, easy money out there right now. Although I did read something the other day that says that it is going to right now get a little bit more difficult to borrow, higher credit score, maybe a little bit more money down because of what's going on.
Yeah.
And the other thing to watch is the banks. So JP Morgan, Goldman Sachs, Bank of America have all set aside money to write down loans in the commercial and the residential market because they know that there's a wave of defaults coming.
Mm-hmm.
So, the banks are positioning there. That's why the Fed gave them all this money
Mm-hmm.
so that they could make a bunch of money trading so that they could offset those losses. So for those of you that are watching JP Morgan and Goldman Sachs come out with these, what they make, $4 billion, $12 billion
stupid number. Record. Yeah. Some stupid number.
Right. And they coincidentally, that's the same amount of money they set aside.
They wrote down. Yeah.
Okay. Who's running the Treasury and the Fed?
Yeah.
The former Goldman Sachs
Yeah.
VP partner and a former JP Morgan executive, and JP Morgan made huge,
Yes, they
$12
did.
billion trading.
Yeah.
So, when you see these things happening, I'm not saying there's conspiracy. All I'm saying is that's a good thing,
Yeah.
because they've given them money at zero interest to earn money so that they can offset these losses. So it's going to be a wash that hopefully won't trickle down to us. But the short-term pain is interest rates, not interest rates, but loan qualifications, they are saying could get a little bit more difficult, higher credit score, a little bit more money down, more difficult to qualify for a mortgage in the near term while things are escalating.
Well, the other thing, let's just stay on the banks, because that was something I watched last week because they all came out with earnings. And just so we're clear, right, they collectively set aside more for bad debt in Q2 than Q1. That was something I was watching last week, and they did that by about 50%. So it's a significant number.
Yeah.
But then there's also Wells Fargo and Bank of America, right? These are two traditional banks, not Wall Street banks. They don't have a trading desk, right? JP Morgan,
Right.
Goldman Sachs, Citi, Morgan Stanley, all made either money trading stocks or bonds, record numbers because of what you went through. But let's talk about Wells Fargo, right? Wells Fargo, at least last time I checked, was the largest bank by asset value. They've been in the penalty box for 4 years now because of the trading account scandal or no, not trading account, but their account scandal, which rightly so. And they set aside the most reserves, just over $6 billion after $4 billion in Q1. You know what? And right now they're the bank that's locking down the most, right? They've raised credit scores, minimums. They said they're not doing refis unless you deposit $1 million with me. And they're not taking any risk, near as I can tell right now. Any thoughts on Wells Fargo specifically?
Yeah, so they have a lot of exposure. So they are in the mortgage market, so that's why, because so that's your indicator, that there's a lot of, default in the pipeline and a lot of, forbearance that they're working out right now. What's the real result of that? What is it really going to look like? And we're not going to know that until next year. We're going to get through the fall. When we get towards the end of this year, it depends. So like a Wells Fargo might be more interested in clearing the books and just getting it off the books. So there could be a wave of foreclosures by, at the end of the year. So for everybody listening, just kind of keep your eyes on that. There could be a foreclosure wave coming the end of this year if what these banks are seeing on their books comes to fruition. And, it doesn't seem like they're going to extend this unemployment bonus, because that's keeping people from going back to work when we want to get people back to work. There might be something, but with businesses shutting back down again in a lot of areas, and without that bonus, and with taxes that were due last week, people have to pay that. There's potential defaults coming down the pipeline, and I think the banks are going to be more interested in just foreclosing and getting them off the books, because they have to mark those assets to market otherwise and carry them on the books, which is more damaging to a bank's ability to lend than just writing it off and getting it off the books.
Yeah, let's get back to making some money, right? So we were talking about flipping. I think there's an opportunity. I think it is in the single family space, because you got to know who's buying today, right? Conventional. I do not think it's in value add multifamily. In fact, I think that's probably one of the worst places to be, unless you get one of those unicorn deals, because there's been no price discovery. Debt's different. Reserves are different. Escrows are different.
So that's a yield play right now.
Yeah, I think it's all about single family homes. And if you're in a hot market where you can tell, right, you can just talk to agents. We're at 60% of normal listings. If you can get in and out, as you said, in 3 or 4 months, I think you have a chance to make some money, assuming you know your market, you know your numbers, you manage the project, all those other things. But I think that's a pretty good place to be today. Would you agree?
Yeah, I think so. The key is going to be finding those. So if you can't find them, build them. So that's a great space to be in right now, doing some spec development. Now that's going to take you 6 months plus, to do that. But I think you're still okay. I think interest rates right now are going to be okay.
Yeah.
If you're in these areas, I think if you can get it done by the end of the year, you're in a little better position. If you're looking for, finished lots that you can all you need the permit, you can get built, and you've got a good builder, the key is going to be getting it done. Time frames in new construction is pretty difficult right now. Flipping houses, but that's where it's at. So if you can bring inventory to the market in residential, right now, some markets it's condos, some markets it's townhouses, some markets it's single family. So know your market, know the sweet spot, and then when you talk about those inventory levels, know the absorption rate. So when they went from 12,000 houses to 8,000, how many were sold? How many are under contract? What's that absorption rate? What does that inventory mean? Does 8,000 houses mean that's a month's worth of supply, or does it mean that's 6 months worth of supply?
Yeah.
So you need to look at that in terms of your timing and how long you can hold out. So if you've got housing you're bringing on the market in the next, 6 to 12 months, that you can work through them if there's that much pent up demand.
Yeah. The other thing I'm just starting to see, and this is a single variable, but I'm curious what you think. It looks like lumber is becoming more expensive.
Oh yeah.
Yeah. So, when you're
Yeah.
talking about building, we could really see inflation in what goes into a house, right? Lumber, steel, cement, all of those things. Is that true?
Oh yeah. Yeah. And that's always the case. As demand rises, those prices go up. Lumber's a commodity, so it's traded. A lot of building materials are. Some of the components are more fixed, but everything has petroleum. There's petroleum-based products. There's shipping to get them there. There's the tariffs that are going on. When all that was happening with China a couple of years ago, we saw steel just all of a sudden shoot up. There was back during the building boom when China was buying up all the concrete and steel everywhere, so that shot prices up in this country. But right now we're seeing the supply chain is a little bit stressed, so they've increased prices to get goods to the job site. Labor has gone up a little bit, and that's really if you want to be in the building business, either the subcontractor, or the developer. That's who's making money. The builders are getting squeezed out because things are going up so much. They can't raise their margins exponentially to keep up with it because the price points just won't make any sense. So it's, construction costs have gone up in the last 2 years, probably 20-25% across the board.
Yeah. And again, inflation in the, basically housing is sticks and bricks, right? It is a collection of commodities. I'm starting to think, and I would not have said this 3 months ago, I think there's a good chance that the single family home could see double-digit price increase or value increase, talking median prices across a lot of different metros this year.
Yeah, well, we're already seeing that in some markets, so it's starting to become more 2009-esque, with low interest rates, values increasing, whereas we saw price point thresholds before, like when I say before coronavirus, so earlier this year, last year, we were seeing a cap. People just wouldn't pay but so much. There wouldn't be these multiple offers, on a lot of properties. Now, in certain markets, in certain areas, that's been going on for the last couple of years, because inventories have been down really for the last couple of years, and interest rates have been really low. And now it's even more in certain areas just because the rates are so low. It just, people are like, man, we might as well own it. It doesn't make any sense not to.
Yeah. And again, I think something that that's not appreciated today that will be appreciated in the next 6 months is we are seeing renters from big cities become owners in the suburbs.
Yeah. The question is, how long will that stay? How long will that remain the case? And that's the big question that we don't know.
Yeah.
And
I think let's debate that a little bit. I think it's going to be stickier than most people think, because we will have a generation that, right now are the millennials, if you will, and young adults that have been raising probably a child or two, or they're single in a vertical city in a shoebox. Then they go to the suburbs, they get a backyard, they get a pool, they get a fenced front yard, they have an extra office for their Zoom calls. I don't see them going back. I think once you get a taste of that, and oh, by the way, you're the owner and you can paint it any color you want and get a pet, I don't see them going back.
Yeah, it's interesting. So when you think about why are they in the city to begin with, usually it's jobs. So a job is what brought them to the city.
That's true.
And then what, the other reasoning, and this is coming from talking to people who have left, like New York, Manhattan, downtown, they were there for work. And they're like, we pay a premium to live in New York for the entertainment. We're here for a job. We can work anywhere in our job. We can work wherever, but we live here because we pay a premium to be here. We don't need a vehicle. We can get around on foot, and we have all this entertainment. Yeah. And when New York shut down, they were like, yeah, there's really no reason to be here. Right. And if it's going to be restricted, that kind of takes the reason away of why we're paying a premium to live here.
Got it.
So that's one reason a lot of people are leaving. The other one is jobs. So now it's like, well, you can work anywhere, and people are like, well, shoot, if I don't have to be here, I'm not going to live here. Because there are people that hated being in New York or being in DC or being in Seattle or San Francisco or wherever. Yeah. And the only reason they were there was for the job.
No question.
So now those people can go wherever. And these companies are saying, you know what, we're going to let people work from wherever they want in perpetuity.
Yeah.
So that is another fundamental change that could, like to what you're saying, could, keep people moving to the suburbs permanently and not revisiting and returning to the city, is that environment. But that's really what needs to happen is the jobs. I mean, that's what brings people to the cities to begin with. People
Totally.
don't go to New York because they're like, I just want to go to New York.
Yeah.
Well, mostly.
Yeah.
They're going there for a job.
Yeah, that's, again, it is all about jobs. You know, I'll just pick on Twitter because that was the first one that I remember saying, you know, you can work from anywhere, get out of here, basically, right? They're headquartered downtown San Francisco. But the other thing I think that I just want to put out there is I don't know what the home ownership rate is today. I think it's 59%. It might be 61. It's some, let's call it 60 for a round number. I think with what we're seeing with the switch from renters to owners, we may see the ownership rate tick up to 62 or 63%, which again, I think is a good thing. I think people owning properties, owning their own home, you know, you own it long enough, you build wealth. And I think that'll be net positive for, you know, the citizens, I think.
Yeah. You know, so that's an interesting question too, because it depends. All right.
Okay.
So in 2009, that wasn't true.
Gosh.
Right. If you lost all your wealth.
Yeah.
So it depends on where you are in the cycle. So, you know, the question is that a place where you're actually building wealth or are you just storing cash?
Okay.
So if you got to live somewhere and make a payment, you're living somewhere where eventually you own it outright. So at least your payment is build it. It's a savings account.
Yeah. For savings.
But is it really going to build wealth? It just depends on where we are in the cycle, because all that needs to happen is for interest rates to go back up over 4%.
Yeah.
It used to be 5, now it's 4. And what happens when that happens? You know, demand goes down, values go down. So the only thing that's driving demand and driving these values is interest rates. And it was the same thing in 2004 and 5 when we were at the peak of the market the first time. And as soon as rates started ticking up, the market started tailing off. And then when financing dried up and interest rates went up in 2009, it crashed. So we will reach that point again. You know, this will be over at some point and inflation will start to take hold. And the only way to check inflation is interest rates.
Yeah.
That's how the Fed controls the economy and takes the, you know, either accelerates or decelerates, inflates, deflates the economy.
Yeah.
At some point, we have to deflate what's happened.
Yeah. So again, right, geez, so much stuff to think about. So again, I think in the short term, just all signs point to higher values in the short term. Call short term whatever you want. Yeah, right now. But you're right. 2030, 2028, 2026, you know, pick a time. Interest rates are going to go up. They can't stay at sub 3% forever. I don't think anybody's calling that.
And here's the big one. So here's the other thing a lot of people aren't thinking about and aren't looking at. Number one, insurance costs are through the roof, especially multifamily. They're double what they were even 2 years ago with all this COVID lawsuits and all that. So interest rates are going up. Costs to operate income properties are going up due to this environment. The big bomb that's going to drop everywhere, property taxes. So we have to fill the holes in the deficit in the cities, states, and counties that have had to shut down and don't have that sales tax revenue that they've been getting. So your taxes are going to go up. So from a property ownership standpoint, you know, I don't know what it's like in your area. You know, my area is not too bad, but New York's like through the roof. New Jersey, I mean, those are places where people pay, you know, 10%. You know, so we're going to see those things start to increase. So that will affect values in real estate as well.
For sure.
You know, the cost of ownership. So when you look at it from that wealth building standpoint, you know, just be mindful of taxes, you know, just be mindful of interest rates, be mindful of supply and demand. You know, everybody said, oh, we're going to be a renter nation, you know. I don't necessarily agree with that. I think there's always going to be people that want to own. Where is that number balanced out? Is it 50%? Is it, you know, like you said, I think right now 30% of all households are rentals, you know, or somewhere around there. Does that get to 50? You know, I just, you know, people want to own. They want to know they don't have to move. They want to know that their rent's not going to get increased on them. They want to know that they can paint whatever they want to paint, whatever, you know. There's always going to be a certain amount of the population that's going to want to own. So that's not going away. The question is, at what point is that not sustainable and affordable? Yeah.
All I know is it's exciting times. It's amazing to think about the opportunities and the things we have to think about for the next 6 to 12 months, given we're in a health crisis. I mean, usually real estate's usually real estate's kind of boring, right? It goes on a trend and you can see the trends coming. Now I would have never guessed supply would be 30% of normal. I would have never guessed.
Yeah, it's an interesting thing. And when you look at the history of real estate over time and you look at the booms and busts, it's all interest rates. It's all interest rates and financing. So that's why the 30-year mortgage became a thing. And so people could buy a house, right? So, so it didn't used to be that way. It used to be savings and loans, and it was a more short-term thing.
Yeah.
So that's number one. Number two, so right now, great time to make money if you can find the deals.
Right.
When it flips and the market starts tanking, you can still make money. And I did very well in 2009 and 10, with my infill strategy. I just chased the market down. So as values went down, I reversed it. So if I was paying 200,000 for that property today that was worth 300, well, if it's worth, 250, well, now I'm paying 175.
Right.
So I led the market down, just like you lead it up.
Mm-hmm.
So if you're ahead of the cycle, you understand the economics, which is interest rates, and days on market,
Yep.
and inventory levels, supply, demand, interest rates. So if you monitor those things, you will be able to stay ahead of that curve and lead the market up and down. And there's always money to be made in each one. It just believe it or not, it gets easier on the way down because you can get more houses.
Yeah. Well, I was just going to say what you just said. It is easier on the way down. My most active year was 2010 because we learned our market. We watched, we knew what was going on. But the real reason is everybody was scared. When the market goes up, I don't know why it is, human nature, everybody chases. The market rolls over, everybody runs away. I'm like, why does this happen every time? And it'll happen again. It just always does. So yeah.
Look at the NASDAQ, man. The NASDAQ's almost double. It's what, 20% above its all-time high right now, and it's almost doubled the bottom where it was at in March when this all started.
Yeah, it's crazy.
What's getting ready to happen there?
Amen to that. All right, man. Well, thank you for doing this. This is fun. I think flipping single-family homes for the conventional loans is a great place to be for the next, let's call it, year. I think that's a wise strategy.
Or building and selling. If you're in that mode and you can do that, bring in brand new inventory, that's the way to go.
Very cool, man. Well, thank you very much for your time.